The traditional playbook for building wealth in the stock market has been carved in stone for decades. It relies on a foundation of rigid rules and slow, steady accumulation. The classic advice, heavily championed by billionaires like Warren Buffett, is straightforward. Buy broad market index funds, accept an average 8% return, and treat the whole process like watching paint dry. But for a modern investor trying to catch up, that 8% target can feel agonizingly slow. If you don't have 50 years to wait, watching paint dry feels less like a strategy and more like a trap. The alternative is to step away from broad market averages and target higher returns through concentrated growth and specific sector ETFs. This comparison table lays out the difference. On the left is the status quo, broad market funds targeting an 8% return with low volatility. On the right is the growth target, concentrated tech and healthcare funds pushing for 10 to 19% returns, but bringing much higher volatility along with them. The cost of moving to the right side of that table is accepting severe concentration risk. You are no longer betting on the entire American economy, you are betting heavily on specific industries. If you try to eliminate volatility completely, you also eliminate your upside. You end up sitting on the sidelines while specific sectors run up massive gains in a single quarter. Choosing to ignore traditional investing rules is a perfectly valid strategy. You just have to acknowledge that you are explicitly trading guaranteed, slow-moving safety for aggressive, concentrated market exposure. Before taking on that exposure, you need to understand the mechanics of what you are actually buying. The most common misconception is that purchasing an ETF means you own tiny fractions of the underlying companies. This flowchart shows the actual structure. When you buy into an ETF, your money flows directly to a central fund manager, not to the companies themselves. That manager takes your capital, pools it with everyone else's, and uses that massive bag of cash to purchase hundreds of individual stocks across the market. You do not own those individual positions. The fund holds the legal ownership and all the voting rights. You simply hold shares in the fund itself, leaving you with zero control over the actual corporations. Because the fund manager is doing the heavy lifting of building and maintaining this portfolio, they charge you a mandatory ongoing fee called an expense ratio. A major part of what you are paying for is active rebalancing. If a single company's stock price skyrockets, its slice of the pie gets too big. The manager steps in, sells off some of those shares, and redistributes the profit to maintain the fund's target percentages. Without this constant maintenance, a single soaring stock could easily swell to consume 30 or 40% of the fund, accidentally over-leveraging everyone's money in one direction. An exchange-traded fund is a managed service, plain and simple. You are paying a premium to outsource the daily maintenance and rebalancing of a complex portfolio, rather than holding physical corporate equity. If you want to aggressively push past the standard 8%, one target for this strategy is the iShares Russell 1000 Growth ETF, known by the ticker symbol IWF. Over a recent 5-year period, this specific fund delivered a 19% return, completely outpacing traditional broad market indices. This stacked bar chart reveals exactly how it achieved those numbers. The fund is extremely top-heavy, with massive allocations in Microsoft at nearly 12%, Apple at 9%, Nvidia at 8%, followed by heavy positions in Amazon, Meta, and Google. Packing the top of the fund with massive tech monopolies acts as a powerful engine. When these specific giants run up, they drag the entire ETF's performance up with them. When we zoom out to look at the total portfolio allocation, the information technology sector alone consumes 43% of the fund's entire capital. Warning tone. That level of density is a double-edged sword. You get the explosive upside of tech, but you are completely exposed if sentiment turns against the sector. A localized event, like sudden regulatory crackdowns on tech monopolies or a disruption in semiconductor supply chains, would rip through this ETF, causing far more damage here than in a balanced market index. Holding IWF means replacing the broad safety of an index with a concentrated bet on mega-cap tech dominance. Because a tech-heavy growth fund is so vulnerable to sudden drops, a portfolio needs a stabilizing force to counteract that extreme volatility. For this strategy, the defensive anchor is the healthcare and medical device sector. The logic here is driven by a stark macroeconomic reality. America has a massive, aging population that requires constant, ongoing medical intervention just to survive. This creates a powerful economic dynamic known as inelastic demand. If the economy crashes, people might stop buying smartphones, but a patient dependent on insulin or a pacemaker cannot opt out of their treatment. This sector scorecard highlights the dominant players providing that stability. Companies like Abbott Laboratories, Intuitive Surgical, and Stryker produce the essential robotic equipment and medical devices that hospitals require every single day, regardless of market conditions. The growth curve for these companies looks very different from tech. You won't see explosive overnight peaks, but during a market panic, they provide a much higher, more stable floor to break your fall. A healthcare ETF functions as the shock absorber for your portfolio. You are purposely sacrificing some explosive upside in exchange for deep, recession-resistant stability. Some investors eventually want to maximize their returns by picking individual stocks, but they know they don't have the current experience to do it safely. Instead of treating an ETF as a permanent, forever strategy, it can be utilized as a transitional tool. You can use it to get paid while you learn the market. This process loop maps out the workflow. You start by holding the ETF. Then you identify the top-performing companies inside it. From there, you do deep fundamental research on those businesses. And finally, once you understand the data, you buy the individual stock. This keeps your money growing with the baseline returns of the fund while you safely investigate individual high-conviction plays, like noticing a company like Eli Lilly dominating the insulin market from inside the ETF's holdings. This approach reframes the expense ratio as a tuition payment for a hands-on market education. Rejecting the standard 8% market average is a deliberate choice. It requires an intentional, mechanical strategy, not just throwing money at blind risk and hoping for the best. This decision matrix breaks down where you fit. If you take on moderate to high risk, but want to remain largely hands-off, you fall into the targeter zone. The aggressive growth and healthcare ETF split is built for this exact profile. The required trade-off here is pure emotional discipline. When concentrated tech sectors take a hit, you have to stomach sharper dips without panic selling. Now, if you want to use the ETF as a stepping stone to single stock picking, you move up into the screener territory. This demands high risk tolerance and a major time commitment for active daily research. And if the thought of a tech pullback causes you genuine anxiety, you belong in the granddaddy quadrant. There is no shame in sticking to broad market, low risk index funds. Because at the end of the day, the ultimate metric of a successful portfolio isn't the percentage return it generates. It is whether the underlying risk profile perfectly matches your emotional discipline and the time you are willing to commit to it.